All right, guys, welcome back to another video. Today, we're going to talk about stocks, okay? Stocks, in its most basic, simplistic form, is simply ownership in a company, okay? That's all that stock is. It's ownership or equity in a company that you can own, okay? So you can think about it like Shark Tank, right? You have the sharks, they're investing money into, somebody comes before them and says, hey, I'm looking for $250,000 for 20% of my company, right? Well, in essence, what's going on is the sharks are purchasing equity or stock in a company in exchange for money, right? So the business gets money, the investor or the shark gets ownership, and that entitles them to a share in the growth of the company or decline, okay, proportionate to how much ownership they have, okay? So essentially, you can be a shark when you're looking at stocks. And these stocks that are available for purchase are they're public companies in the sense that they're offering their shares to anybody that wants to buy them. And you can go onto any stock exchange and purchase shares, okay? So when you do that, you can act like a shark. You can say, okay, well, I like Tesla. I like Elon Musk as a leader. I like their product. I like their innovation. I think that they're doing great, right? So I'm going to buy stock in their company. I'm going to buy equity because I want to participate in the growth of that company, okay? That's essentially what you're doing, just on a much larger scale than what the sharks do on Shark Tank, okay? So you get, with your little ownership, your percentage of ownership of the company, you get your proportionate share of growth and decline in the value of the company. You also get your proportionate share of any dividends that are paid out. So let's say the company has a lot of profits. They can, if they choose, decide to spread some of those around. Instead of keeping it in the company and reinvesting it, they might decide to do a dividend distribution to all of their shareholders, and you would get a proportionate share of that dividend, of that payout. Okay, you get your share of the profits. So on Shark Tank, right there, one shark owns, 15, 10, 20, 30% of a company. So they're going to get 30% of the revenue, of the growth, all of that, right? In the stock market, these companies are massive. They have a ton of shares outstanding. And so when you buy 100 shares of a company, you're buying a very tiny percentage of that company. And so you get a very tiny percentage of the revenue, okay? But it's all proportionate. It doesn't matter what the price of the stock is, per share. That really doesn't matter. You get whatever percentage of ownership that you own divided by the number of shares that are owned in total, okay? So you might hear the words large cap, mid cap, small cap, okay? When you're looking online, maybe you're looking at your broker like Fidelity or Vanguard, you're looking at different stocks and you see those terms pop up. Well, they are simply categories to define size of a company, okay? So when a company issues shares of stock, okay, the total value of that stock all combined is the value or the capitalization of the company. And so whatever shares they have, however many shares in total there are, times by the share price gives you the market cap or the market size of the company. So when you hear large cap, you are looking at companies that are valued at $10 billion or more, okay? So the total share, the total aggregate amount of their shares outstanding is $10 billion or more. These are massive companies, okay? You can probably think of these companies off the top of your head, right? Google, Facebook or Meta, Amazon, Tesla, Apple, right? These are massive, massive companies, okay? Mid cap are just a tier below, okay? They have a total market capitalization of between $2 and $10 billion, okay? Obviously, still big companies, but just a little bit smaller, okay? And small cap stocks are much lower than that, between $300 million and $2 billion, okay? So you can go and search and say, I want to look at large cap or mid cap or small cap stocks, and I want to buy mid, large, or small cap, okay? The reason that they've classified these this way, they have, the industry overall has really categorized and classified about every type of stock out there, okay? They've done it by company size, they've done it by industry, they've done it by sector, and so they've divided it all out so they can cross reference and understand how certain types of stocks are performing in comparison to other types of stocks. Okay, so let's talk about really simple example here about why a company might go public, right? And might have shares available for public purchase. Okay, offering a security, which is any type of investment, is a highly regulated process. And there are a lot of different types of securities or investments out there, but ownership in a company, right? Stock in a company is a security and it has to be registered as such. And there are a lot of rules and regulations around who can own a security, different types of securities. Okay. So if a company gets started, we can think about a lot of startups that we hear massive valuations, right? They grow to be unicorns and then they go public, right? They do their initial public offering, an IPO, and then you can buy their shares on the stock exchange, right? These companies issue shares of stock privately in private offerings, and they raise, right, a seed round or a round A or B or C or D, and they raise more and more money at higher and higher valuations and issue shares of stock, okay? So essentially, the company is taking investment dollars in exchange for equity, just like the sharks. Okay. When you're a small company, right, maybe you raise $1 million, $500,000 in seed capital. And then your next one, you might raise, $4 million or whatever. The trajectory for every company is a little bit different. But essentially, these companies they need capital. Right? They want capital to be able to grow in a specific way. And so what happens is they say, hey, we'll offer you some of our company if you give us capital, right? And they might use that capital to grow, right? They might invest in new technology. They might go out and do a big round of hiring, right? To bring in a higher headcount for employees, whatever they need to do to grow, they start using that capital to go do it, okay? Well, at a certain point, a company might have a valuation, right? From all these private raises, they might have a valuation that's high enough where they say, hey, actually, we want to go public. And going public is more about raising money and providing a liquidation, right? Or an exit for investors and owners in the company, right? Anybody that owns shares at that point. Because once you are public, you can freely exchange, buy and sell shares. And so frequently a company they'll do an IPO, and all of the shares that are outstanding all of a sudden are listed on the stock market, and people can sell them if they own them. So employees that have stock options or investors that had in or founders of the company, they can actually sell their shares and get the value, right? So obviously, if you've been in the journey along the way, then you're getting a ton of value that way, right? You're getting a lot of appreciation in the value of those shares. So when you IPO, essentially all shares become public shares. They go onto an exchange and they are bought and sold there. But the company can also issue additional shares, and they might offer additional shares to raise more capital. Essentially, it's another funding round, okay? But they're doing it instead of a private funding round, they're doing it for the general public. So they're saying, hey, we're going to go out and we're going to IPO and issue additional shares in addition to, all the shares that have already been, that are owned by investors or employees or whoever, okay? So then they IPO and they can raise a ton more money, and everybody that owns current shares can exit, right, and sell at a higher point and kind of cash in on the value that they've held in those shares all that time. And then the company can continue to grow and so forth, right? It just goes from being a private company to public. The company gets to decide how many shares they want to issue. They get to decide how many of them they want to share right now. They could have a bunch in the coffer and not sell additional shares. And time after time, they might decide, hey, we want to issue more, we want to put out more shares. So then they put them out on the market, they sell them, okay? And they do a secondary offering and so forth. So there's a lot of reasons why a company might want to go public, but the basic reason is an exit for current shareholders so that they can capitalize on their investment, right? And get their money that's now grown, hopefully, by a lot. So when you see companies that are out in the public markets now trading, when you go buy a share, the company isn't getting that money anymore. Okay, that's something that I think is really important to understand. You're not giving more money to the company. You're simply buying a share that's already out there owned by somebody else, right? So I might own a share of Tesla and maybe I decide I want to sell it, and somebody else, you might come along and say, I actually want to buy a share of Tesla. So then you are just buying my share. So I get the money, you get the share. Okay, so then we're trading between ourselves, but you're not giving the company more money by buying stocks at this point, right? unless they do another offering of outstanding shares or you get in on their initial public offering. So one big money raise, but then after that, when you buy and sell stock, you are doing that with individuals or institutions that are investing in the company. The company's not getting that money anymore, okay? So it's important to know that, because the value of the stock and the value of the company, they're not always exactly the same thing. It's more about, what do you think this stock is worth, and am I willing to buy it at that price from you, a private seller, essentially, okay? So I'm going to wrap this part up here, and we're going to talk about more of the mechanics of the stock market coming up, and especially the indexes and what those mean for us. Okay? See you guys in the next video.
Invest with purpose.